So let's talk about Forex. You've probably heard the term thrown around online, often with pictures of fancy cars or people working from laptops on a beach. But what it actually is, when you strip away all the hype, is surprisingly simple. Forex is short for foreign exchange, and it's the largest financial market in the world. It's the global marketplace where national currencies are traded against one another. Think about it. If you've ever traveled to another country, you've participated in the Forex market. When you exchanged your US dollars for euros to buy a croissant in Paris, you made a Forex transaction. Billions of dollars are exchanged every single day, not just by tourists, but by banks, corporations, and individual traders. The reason this market exists on such a massive scale is because of international trade and investment. A company in the United States that wants to buy raw materials from Japan has to pay in Japanese yen. To do that, it needs to sell its US dollars and buy yen. This constant buying and selling is what makes the values of currencies fluctuate every second. Now, individual traders, often called retail traders, get involved for a different reason. They aren't trying to buy goods, they are speculating on these price fluctuations. They aim to profit by predicting whether one currency will get stronger or weaker compared to another. It's like a massive global economic tug-of-war, and traders are trying to guess which side will pull harder. Unlike the stock market where you buy a piece of a company, in Forex, you are essentially betting on the economic health of an entire country. When you buy a currency, you're making a bet that its country's economy is doing well or will do well in the future. This makes Forex trading fundamentally different from owning shares of Apple or Tesla. You're not investing in a product or a CEO, you're investing in macroeconomic trends, interest rate decisions made by central banks, and geopolitical events. It's a market that operates 24 hours a day, 5 days a week, because as one major financial center closes, another one opens somewhere else in the world, passing the baton from Tokyo to London to New York. The allure for many people is the accessibility and the potential for profit from small price movements due to leverage, which we'll get into later. You don't need millions of dollars to start. But it's crucial to understand that it's not a get-rich-quick scheme. The very same leverage that can magnify your gains can also magnify your losses just as quickly. The goal for a beginner should be to understand the underlying mechanics, why currencies move, what factors influence them, and how to read the market's language. It's about analyzing data and making educated guesses, not just clicking buy and hoping for the best. This is where education becomes your most valuable asset, long before you ever risk a single dollar. To start trading Forex, you need to understand its language, beginning with currency pairs. Currencies are always traded in pairs, like the EUR-USD. The first currency is the base currency, and the second is the quote currency. The price you see represents how much of the quote currency one unit of the base currency can buy. If you believe the base currency will strengthen, you buy the pair. If you think it will weaken, you sell. Currency pair prices move based on supply and demand, driven by a country's economic performance. This creates constant price movement, or price action, that traders analyze. Prices often hit invisible barriers called support and resistance. Support is a price floor where the price tends to bounce up. Resistance is a price ceiling where the price struggles to break through. Trend lines connect a series of highs or lows, helping you see the market's direction. It could be an uptrend, a downtrend, or a sideways range. Many traders use technical indicators like the exponential moving average, or EMA, to gauge the trend. Finally, traders look for supply and demand zones, which often act as magnets for future price action. Let's walk through a real strategy many day traders use, the opening range breakout, or ORB. This strategy focuses on the high volatility opening of a major market session, like the New York Stock Exchange. The idea is simple. The first few minutes often establish a temporary high and low for the day. The ORB strategy aims to capitalize on the moment the price breaks out of this initial range, signaling a potential trend. First, define the opening range by marking the high and low of the first 15 minutes of the New York session. Draw horizontal lines at these levels to create a range. Wait for a candle to close firmly outside this range, signaling a breakout. A close above the high is a buy signal. Below the low is a sell signal. Place your stop loss on the opposite side of the range and set take-profit targets at multiples of your risk. This structured approach separates methodical trading from gambling. To execute any trading strategy, you need the right tools. Think of it like being a carpenter. You wouldn't try to build a house with just a hammer. For traders, the workshop consists of charting software and a brokerage platform. The most popular choice for charting and analysis is TradingView. It's a powerful web-based platform that provides traders with incredibly detailed charts for virtually every market imaginable, from Forex pairs like GBP to USD, to cryptocurrencies like Bitcoin. It's here that you do all your homework, drawing trend lines, marking support and resistance zones, and adding technical indicators like the EMAs we discussed earlier. It's your canvas for mapping out the market. Once you've done your analysis on TradingView and have a trade plan, you need a way to actually place the trade. This is where a brokerage platform like MetaTrader 4 or its successor MetaTrader 5 comes in. These are the workhorses of the retail Forex world. You connect your broker account to MetaTrader 4, and it allows you to execute buy and sell orders with just a few clicks. While TradingView is for looking at the big picture and planning, MetaTrader 4 is for pulling the trigger. The combination is powerful. You use the advanced analytical tools of TradingView to find your opportunity, and then switch to the fast, reliable execution of MetaTrader 4 to manage the live trade. Within these platforms, you can customize your setup with various indicators. We already touched on the EMA and the opening range breakout, but there are hundreds more. Some traders use indicators like the Relative Strength Index, or RSI, to measure if a market is overbought or oversold, while others use the MACD, or Moving Average Convergence Divergence, to gauge momentum. The key is not to clutter your chart with dozens of flashing lines and colors. A common mistake for beginners is analysis paralysis, where they have so much conflicting information from too many indicators that they can never make a decision. The best traders often use a clean chart with just a few well-understood tools that work together. Beyond the platforms and indicators, some traders also use automated tools, sometimes called trading robots or expert advisors. For example, there are robots like Forex Fury designed to automatically trade specific strategies, such as range breakouts. These tools can execute trades 24/7 without emotion, which can be a huge advantage. However, they are not a magic bullet. They require careful setup, monitoring, and an understanding of the market conditions they are designed for. Whether you trade manually or with automation, the foundation remains the same: a solid understanding of the market and a clear, back-tested strategy. Your tools are there to help you implement your plan, not to create one for you. Consistently profitable traders understand one critical thing: risk management. It's the most important part of trading. Even the best strategy can fail without it. Protect your capital. The goal isn't to win every trade, but to ensure your wins outweigh your losses. The most fundamental tool is the stop loss, a preset order to automatically close a trade if the price moves against you. It's your safety net. Placement is key. It should be logical, giving your trade room to breathe without risking too much. Another key concept is position sizing, how much to buy or sell based on your account size and risk tolerance. Risk no more than 1 to 2% of your account on a single trade. Combine this with your stop-loss placement to calculate your exact position size. This prevents emotional decisions and ensures you live to trade another day. Smart traders manage trades in profit, taking partial profits and moving stop-losses to break even. It's all about playing smart defense. Trading can feel like a very solitary activity. It's often just you, your charts, and the endless stream of market data. This isolation can be tough, especially for beginners who are trying to navigate a steep learning curve. This is where trading communities come in. In recent years, online groups on platforms like Telegram, Discord, and Twitter have become invaluable resources for traders of all levels. These communities serve as virtual trading floors where people can share ideas, ask questions, and learn from each other's successes and failures. Instead of trying to reinvent the wheel all by yourself, you can tap into the collective knowledge of hundreds or even thousands of other traders. One of the biggest benefits of a good trading community is the real-time feedback and shared analysis. Many groups like the Trade with Pat community mentioned in the research have experienced traders who share their live trade ideas and explain the reasoning behind them. For a new trader, seeing a strategy like the opening range breakout applied in real time is a game changer. You can see how a professional identifies the range, waits for confirmation, and manages the trade from entry to exit. It's like having a mentor looking over your shoulder. You can compare your own analysis with theirs, which helps you spot mistakes in your own process and learn much faster than you would on your own. Beyond just trade signals, these communities provide a crucial support system. Every trader goes through losing streaks. It's an unavoidable part of the business. When you're trading alone, a string of losses can be incredibly demoralizing and can lead to emotional decisions like revenge trading. Being part of a community reminds you that you're not alone. You can share your struggles with others who understand exactly what you're going through. They can offer encouragement, share their own experiences with similar rough patches, and help you maintain the discipline and psychological fortitude needed to stick to your trading plan. This emotional support is just as important as the technical analysis. Furthermore, these groups are hubs for continuous education. The markets are always evolving, and there's always something new to learn. In a community, members share educational resources, review new strategies, and discuss the impact of major economic news. Many communities also host live Q&A sessions, webinars, and provide access to educational content that helps members grow. Whether it's a free group on Telegram or a paid VIP channel offering more in-depth analysis, the value lies in the shared goal of becoming better traders. Finding a reputable community can significantly shorten your learning curve and make the journey a lot less lonely and a lot more collaborative. As we wrap this up, it's essential to circle back to the most important truth about Forex trading. It is not a shortcut to instant wealth. The internet is filled with promises of turning a few $100s into a fortune overnight, but that is not the reality of this profession. Successful trading is a skill, and like any other high-level skill, it requires a serious commitment to education, countless hours of practice, and an immense amount of patience. Before you even think about trading with real money, your first investment should be in your own knowledge. Read books, watch videos, study charts, and learn the fundamentals inside and out. Your goal should be to learn how to trade, not just to make money. The journey begins with a demo account. A demo account allows you to trade with virtual money in a real, live market environment. This is your sandbox, your flight simulator. It's where you can practice your strategies like the opening range breakout without risking a single penny of your hard-earned cash. You can test your ability to identify support and resistance, draw trend lines, and manage your trades. You can make mistakes, learn from them, and build the confidence and consistency needed to trade live. Don't rush this phase. You should only consider moving to a small live account once you have been consistently profitable on a demo account for several months. When you do go live, start small. The psychological shift from trading virtual money to real money is significant. Every tick against you feels more painful, and the temptation to break your rules becomes much stronger. By starting with an amount of money that you are genuinely okay with losing, you can focus on executing your process correctly, rather than obsessing over the profit and loss. The objective is to prove your strategy and your discipline in a live environment. As you build consistency and your account grows, you can gradually increase your position size. It's a marathon, not a sprint. Ultimately, Forex trading can be a rewarding endeavor for those who approach it with the right mindset. It offers incredible flexibility and intellectual challenge, but it demands respect. It's a world where the disciplined and the prepared take money from the impulsive and the unprepared. So treat it like a business, not a casino. Focus on your education, practice with patience, manage your risk obsessively, and set realistic expectations. The market doesn't owe you anything. Your success will be a direct result of the effort, discipline, and strategic thinking you are willing to put in over the long term.